Chances are you've used Shopify without even realizing it. I mean, if you've ever bought something from a cool online store, Shopify was probably the engine running in the background. They're an absolute powerhouse in e-commerce. But the big question is, does that automatically make their stock a good buy? Well, that's exactly what we're going to unpack. Think about it. Shopify is the backbone for millions of businesses, from your neighbor selling handmade crafts to huge global brands. It gives them all the tools they need to build and grow online. Its success is just undeniable. It's a key piece of the entire digital economy. And here it is, the classic dilemma for every investor, right? You can have an amazing, world-changing company, but the price of its stock can be a totally different beast. The two don't always line up, and that gap is everything. Let's break it down. So here's our game plan. We're going to tackle that quality versus price problem head on. Then we'll get into the numbers and calculate what the company's actually worth. After that, we'll do a deep dive on the business itself, look at some possible future scenarios, and then finally, figure out what the right price to pay really is. Okay, first things first, let's really set the stage for this core conflict. It's the question that keeps investors up at night. How do you buy into a fantastic business without completely overpaying for it? To get to the bottom of that, we need to talk about a really important idea called intrinsic value. Basically, it's about cutting through all the noise and the market hype to figure out a company's true underlying worth based on the actual cash it's expected to make down the road. All right, let's get to the juicy part, the numbers. This is where we see what a deep, fundamental analysis says Shopify is really worth, away from the day-to-day stock market chatter. So let's start with what the market is saying. If you were to look up the stock price right now, reflecting all that public opinion and excitement, this is the number you'd see. $179. Okay, lock that number in your head. That's the price tag the market has slapped on Shopify. But what if we ignore that price for a minute? What happens when we build a valuation from the ground up using just the hard financial data and some realistic projections? Well, you get a very different number. Okay, $81. Just let that sink in for a second. We're talking about a massive gap here. And look, this $81 figure isn't just a random guess. It's the result of some pretty serious financial modeling, a blend of two different methods to be exact. And this slide just lays it all out, plain and simple. The market price is more than double what this analysis says the company is intrinsically worth. The takeaway here is pretty stark. The stock seems seriously overvalued right now. So why? What's the story here? What makes Shopify such a high-quality business? But at the same time, what are the risks that are making this analysis so much more cautious on the price? Let's dig a little deeper. On the one hand, the strengths are just incredible. Shopify's business model is a thing of beauty. It doesn't need to build a ton of warehouses to grow. It gets that steady, reliable subscription income plus a piece of every sale its merchants make. And once you're on their platform, it's a real pain to leave. That creates a powerful competitive advantage, a moat, as they say in investing. But it's not all sunshine and rainbows. There are very real risks. You've got giants like Amazon breathing down their neck. The explosive growth they saw during the pandemic is slowing, which is natural. And while they are getting more profitable, it's still a work in progress. All of these things are like a reality check that keeps the valuation grounded. A smart analysis doesn't just look at today. It has to consider all the different ways the future could play out. And that's exactly what we're doing next, with a look at Shopify's strengths, weaknesses, opportunities, and threats. Now, this is really interesting. It's not just about listing these things. It's about how much weight you give them. As you can see, the strengths, like their massive scale and brand, get the biggest chunk at 35%. But check this out. The weaknesses, mainly that sky-high valuation, are seen as being just as significant as the massive opportunity for future growth. That's a really telling detail. And that way of thinking leads to a range of possible values. Our base case, the most likely outcome, is that $81 figure. But, if things go south, the value could drop as low as $55. On the flip side, if everything goes perfectly, we could see a value of $115. But here's the kicker. Even in the best-case scenario, it's still way, way below that current market price of $179. So, if $179 is too expensive, then what is the right price to pay? Okay, let's get really practical and translate all this analysis into some clear, actionable buy prices for an investor. This table is where the rubber meets the road. It shows you exactly what you need to pay today to get a certain return on your investment over the long haul. So, for example, if a 5% return is good enough for you, you could justify paying $140. But this analysis is aiming for 9% a year, which is a pretty common target. And to hit that goal, the buy price has to be $90. And how long you plan to own the stock matters too. If you're looking at a shorter 5-year timeline but still want that 9% return, you could pay a bit more, up to $120. But the longer your investment horizon, the more disciplined you have to be with your entry point, which brings us right back to that $90 price for a long-term hold. So there you have it. We've walked through the whole process. We've looked at the business, we've crunched the numbers, and we've set our price targets. Now it's time to put it all together for the final verdict. I think this quote from the analysis just says it all. Shopify is an excellent business, priced as if excellence is guaranteed. The market isn't just pricing in success, it's pricing in absolute perfection, with zero margin for anything to go wrong. And that means the conclusion is pretty clear. At its current price of $179, it's a sell, or at the very least, a stock to avoid. This is a fantastic company to keep on your watch list, but it only becomes a really compelling investment down around that $90 mark. That's where you get a buffer, a margin of safety, just in case things don't go perfectly. Which leaves us with one final question for you to think about. When it comes to your own portfolio, are you willing to pay a price that assumes a perfect future? Or do you prefer to wait for a price that gives you a cushion, knowing that the future is almost never as perfect as we hope? Something to think about.